But here you've seen over the last several months, this curve up here. And the gray areas are recessions. So what you notice in almost every recession, you see a subtle tick up in the unemployment rate, and then it kind of shoots higher through the recession. So we seem to be on that curve up here that could very likely follow through with a very much higher spike in unemployment. Hello, everybody. This is John Lodra. I'm a founder and partner here at New Harbor Financial Group, here for a timely take. These are periodic briefings that we give for very timely topics that are coming out in the moment. This week, it's Friday, August 2nd, 2024. This week, of course, there's nothing more than we can focus on in this timely take than the recent Federal Reserve interest rate policy meeting and the employment picture that has emerged here in recent days and weeks. So I want to get right into it. So the July Fed meeting happened a couple days ago on Wednesday, July 31st. Not a whole lot of surprises in terms of the action. The market had assigned a very low probability that there would be any movement on interest rates by the Fed. And in fact, that's what happened. The Fed kept their target Federal Reserve target rate at range of 5.25 to 5.5, where it's been since July of 23. So that was no surprise. What the big news in the Fed meeting was a changing in their messaging. So here is a redlined indicator. So basically anywhere where there's a strike through, it means they removed words, and anywhere there's an underlined added word is language they've added. Basically, whereas much of the last year, the Fed has been really focused on fighting the fight against inflation. This meeting, they very dramatically shifted the focus to their dual mandate, not just inflation, but what they also call stable employment. And in that shifting, it really is telling where their concern has quite abruptly shifted. So you can see here, instead of the job gains have remained strong, they indicate they moderated. And the unemployment rate moved up but remains low, so on and so forth. You can see the language here that basically they're shifting their focus from just inflation to both inflation and increasing the job market. And that's where we see here, it talks about both sides of its dual mandate. I highlighted this language here because it basically still hasn't given, the Fed still hasn't given a total green light that they have met their inflation goals. It basically says that the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that the inflation is moving sustainably toward 2%. So they publicly say they're not quite convinced yet that inflation is on the permanent track towards 2% that they want it to be. But clearly the key takeaway here is the employment picture. And it seems quite proper that that's where their focus is, because we've actually seen a pretty dramatic deterioration in the employment picture. We've gotten a number of employment reports here that have painted an increasingly worrisome picture. Earlier in the week, we had ADP payroll report come as private payroll report compiled by ADP, the big payroll company. That came in weaker than expected. Just yesterday, I believe it was, the Institute of Supply Management, I think ISM, they came out with their manufacturing activity PMI, and in particular, the manufacturer employment index was really weak, much weaker than anticipated. And today, the Bureau of Labor Statistics put out its non-farm payroll report and unemployment report. Oftentimes, there's disagreement between the ADP report and the Bureau of Labor Statistics report. But the report that came out today painted a really negative picture on the job market. So all these different reports seem to be all of a sudden coming in pretty dramatically lower. So today's job gains were only 114,000. That was way lower than the expectation of 176,000. The unemployment rate, most importantly, ticked up to 4.3%. So this is right off the Federal Reserve's website. It goes back to the 50s or so, or maybe even before the 50s. And you can see this is the unemployment rate. We got really high here very temporarily during the COVID spike. But here you've seen over the last several months, this curve up here. And the gray areas are recessions. So what you notice in almost every recession, you see a subtle tick up in the unemployment rate, and then it kind of shoots higher through the recession. So we seem to be on that curve up here that could very likely follow through with a very much higher spike in unemployment. There were other data this week, the JOLTS, the so-called JOLTS quit rate. It shows basically how many people are quitting because they feel confident they can find another job. That plummeted quite dramatically from expectations. So there's clearly some uneasiness in the job market, both on the ground, people in their outlook for their job picture, but also clearly in the data. And interestingly enough, today's unemployment report caused a triggering for the so-called SAHM rule, S-A-H-M. This is a picture of the SAHM rule going back to the 60s. Basically, the SAHM rule, and we just had the privilege of being able to follow up Claudia Sahm. She's the kind of namesake for this rule. She's an economist that appeared on Adam Taggart's Thoughtful Money channel, but Mike Preston and I here at New Harbor were able to follow up her presentation, her conversation with Adam. So highly encourage folks to listen to that. At the time, the SAHM rule was very close to triggering, but it hadn't triggered yet. It triggered today with today's unemployment report. And basically what it says is when the unemployment 3-month average unemployment rate is 0.5% higher than the low in the prior 12 months, it triggers a SAHM rule. And today's action in the unemployment rate triggered that. So you can see basically every instance in a major recession, that SAHM rule, once it triggers that 0.5, it shoots higher. So a lot of data here that suggests we are on the verge of, or if not already in. In fact, the SAHM rule basically is meant to be a switch that says, hey, we are in recession when this triggers. So there's obviously going to be some debate about that, but there's a good chance we have entered official recession, that the traditional classifications will only do so after the fact. Notoriously, the Recession Dating Bureau always kind of dates recessions retroactively, but this is a pretty good indicator that we may very well be in the early stages of recession. So let's talk about the response to all this. Most notably, the response has been in interest rate expectations, especially at upcoming Fed meetings tool. This is basically the market's implied probability of rate action. So I'm looking at the September meeting. So it's on September 18th. And what you see here, the market assigns 0 probability that the Fed will keep rates at the current level. In other words, they are 100% certain, the market, and the market can get wrong, and it has many times, 100% certain the Fed will cut at least by 25 basis points, which would bring it down to a rate of 5 to 5.25%. But this is really interesting. This probability of a drop to 4.75 to 5%, basically a 50 basis point, 0.5% drop. The probability of that jumped from only 5.5% a month ago on July 2nd to 70.5%. So the base case is strongly pricing in that there'll be two 25 basis point drops at the September meeting. Let's just look at the December meeting, and you can see there's even pricing in much more drops at this point. So for example, this would be a full percentage point drop, almost 40% that rates will have dropped a full percentage point from current levels by the December meeting, and even a greater probability that they will have dropped 1.25%. So pretty dramatic changes here, and you can see the probabilities were much lower even just a day ago. Yesterday, there was only a 2.6% probability that the Fed would drop to 4 to 4.25 by December. Now there's a 42% chance. So very, very dramatic repricing of interest rate expectations, but also, appearance of kind of recession type environment being upon us. I'm doing another video, our full length feature weekly video, and I'll talk about what we think the market implications of this are, and looking ahead, how one should be positioning their portfolios in light of this interest rate environment, but especially the prospect of a recession. So please watch that video, which will drop very close to this one, maybe within a day or two. But I want to thank you for watching, and until next time, I wish you a great day.